Thank you very much, Dirk Willem. It's a pleasure to be back here at ODI. It's where I started my career in development, if you want to call it that, as a research assistant about 20 years ago, and we've had a close working relationship ever since. I want to take, I think, a slightly more sceptical attitude to foreign private capital than in the last presentation, but mainly just to say just how much most of what you had to say dovetails really exactly with what we've been finding as well in our work. And to say that I've just come back from the IMF and World Bank annual meetings where we had some very active discussions about regulation and how that might impact. I was there with a group of Africans talking to the Federal Reserve and so on, so if people do want to raise questions about that afterwards, I'm most happy to get into that discussion. But let me talk a little bit about the study that we're launching today. First of all, I'll give you a bit of context and methodology, and then I'll talk about the key findings in terms of trends and composition of private capital flows to low-income countries in Latin America and Sub-Saharan Africa, and the facts of boom and bust. And then I will hand over to Nils to talk about what drives the flows and what they're actually achieving for development, not just for growth, in terms of not just investor perceptions of what types of things encourage or discourage them, but also their intentions, where they're putting their money, and their concrete actions in terms of corporate responsibility and other contributions to development. And then I'll come back in finally after Nils has finished that for some policy implications. So, the context and the methodology that we're using. This is a study, which I think you've all had copies of, which is based, it's about the behaviour and development impact of foreign private capital, and the same types of flows that Isabella just talked about, before and during the financial crisis. It's based on surveys of 9,000 investors in 24 countries, and that includes foreign and domestic investors, multinational enterprises, small and medium enterprises, all sectors, all source countries, and so on. It's been conducted under what's called the Foreign Private Capital Capacity Building Programme, which has been principally funded by the Swiss government, was also until recently funded by the British government, and has had Danish, Swedish and World Bank country-specific funds, but is most importantly roughly half funded by the national stakeholders in the countries themselves, because they think it is so important to monitor and analyse these issues. And the objective of that programme has been to build country capacity to maximise the contribution of foreign private capital to development via more effective monitoring, analysis and policy actions of their own. We've executed that programme in partnership with regional capacity building organisations who are listed on the front cover of the report and credited inside, and we have, I'm very pleased to say, decentralised our activities in this programme to them as of September 2009. And we've also, it's based on a huge amount of work by what's called a national task force in each of these countries, staff of central banks, investment promotion agencies, statistics offices, line ministries and so on, as well as all the key private sector associations, Chamber of Commerce, bankers associations and so on. They've done all the really hard work of the surveys, and they've written analytical reports of about 150 pages each, which you can see online via our website. And I say this, I hope, directly to them, because quite a few of them said they might be connecting online, because they're in places like Tanzania and Bolivia to this presentation. So I want to say to you, if you are online, you're the ones who deserve all the credit for this presentation that we're making now. And I think probably one of the most important things about the programme is it's really provided a platform for the design of a wide range of policies, government policies relating to investment promotion and to macroeconomic stability through a dialogue between the government and the private sector. So let me move on to what's been happening and what is happening, and I'll cut out some of what I was going to say because it so much fits with what Isabella said I don't need to say it. I think we all know that there have been rapid rises in foreign private capital to developing countries. Until recently, an alarmingly large number of people intended to assume that low-income countries weren't seeing those flows. And I'll just show you, that's the chart for developing countries as a whole, and that's the chart for low-income countries. They look remarkably similar, albeit that if you looked at the left-hand side, you would see that the scale of the flows to the low-income countries is much smaller. The reality is that low-income countries have been having a real boom in foreign private capital. We did an earlier book, which you can get copies of from Jeanette, who's sitting at the back at the end, called Private Capital Flows to Africa, Perception and Reality, about 10 years ago, when the countries we were working with first started noticing this. And frankly, not very many people believed us. We had a presentation in the city where we said, you know, there's a boom in these flows going on and countries are having to cope with it, and people went, no, there isn't. And we noticed this huge gap between the fact that on the ground there was a huge amount of investment coming in and the perception here, for example, in the UK, that they didn't really want to invest in Africa. It was a basket case, and, you know, why were we even raising the issue? And since then, I think that's changed a lot. And often people say it's largely workers' remittances. But the thing I want to really stress, and I think it's even true of the international data that have been used in Isabella's study, is that there is a huge underestimation going on of FDI and of short-term bank lending in Africa. When we have been doing these studies with all of the countries, we've typically found that the amount of FDI going in is about twice what people think it is in the international data. Even now, though Global Development Finance and the BIS have been catching up, and the BIS figures are more reliable, but they only cover a certain number of banks. The global FDI figures are really unreliable and very underestimated for the low-income countries because the recording has been so bad. In very many cases, this is a very high proportion of low-income countries' GDP and capital formation. I mean, I'll just show you one more graph, which is the percentage that FPC, foreign private capital stock, represents in relation to GDP. And you can see, okay, the Malawi figure is pretty old, but it's between 30 and 75% of countries' GDP. So it really is very big. If you looked at gross fixed capital formation, it's even higher. So there was a lag in terms of global policy noticing this. And as a result, I think it would be fair to say that very little was actually put in place to protect countries against the strong potential effects of the global crisis. I even had a call from a very senior British policymaker before about the end of 2008 saying, do you actually think that the international financial crisis will hit Africa? Because the level of knowledge was so low about the scale of the connection to the international markets. It's also very important to realize that long before the crisis and long after the crisis this will continue, low-income countries were already experiencing dramatic volatility with huge macroeconomic and social impacts on them in foreign private capital. And I take two examples. One was Ashanti goldfields in Ghana, where a rather bad hedging operation almost made the whole country run out of foreign exchange reserves. The second was the withdrawal of Anglo-American from Zambia, which essentially deprived half of the country of most of its schools, hospitals, and other facilities, as well as a huge number of mining jobs. So this kind of volatility went on before, usually expecting sort of external decisions, like Anglo-American's decision to change its business model, or investor-specific factors. But it's there, and it has been having major impacts for about 10 years now. But it somehow took a global crisis before the international community started to worry about this. I won't duplicate what Isabella said. We have the same sort of message about what happened in the crisis, cancelled or postponed new equity projects. Also, what we noticed was a very much higher capital repatriation by investors. So the ones who were already there started sending money out. And that's something I'll come back to in a minute. Reversals of portfolio flows, as she said, contractions in borrowing, particularly contractions in trade credit, which is so vital for imports and exports. As the commodity prices fell, people cut back their potential exposure in those areas. And as she said, some of those things have been reversed, but not only is FDI to most LICs still stagnant, if not falling, but repatriation levels are even higher now. I think what you see is a lag effect where people took their decisions about investment during the end of 2008, early 2009. Now you're really seeing that feeding through into what they're doing with their money. Okay, what's really important here is the more detailed composition, which our work with the countries has enabled us to look at. And what you find is that what looks like FDI and what is declared by UNCTAD and the World Bank to be FDI has a very high proportion, in many cases as high as 50%, of debt involved in it. Principally borrowing inside companies from the subsidiary to the parent company. And there's also a very high percentage of short-term debt. And so you find that by 2008, 2009, in most of the low-income countries we were looking at, private sector debt was considerably higher than public sector debt. The second aspect that's very important that we found from looking at what happened in the crisis is that there's a sort of traditional analytical hierarchy where people say FDI is quite stable and portfolio and bank flows are very volatile. It's rubbish. There is a very big volatility in equity. It can be either cancelled, it can be postponed, it can be withdrawn, it can also be, profits can be repatriated much more rapidly and are. And also there's this large component of the FDI which is debt, which the subsidiaries can be forced to pay back to their headquarters overnight if things are looking bad. So what do we come out of, in terms of recommendations and conclusions from this is that there needs to be a great deal more attention paid to the detailed composition of the flows, particularly that people need to spend much more time looking at these deals very closely to see whether they genuinely are funded with equity and not co-financing or guaranteeing bank loans so much. Monitoring the debt in great detail, looking at all sorts of ratios and risks, and discouraging excessively leveraged projects. We've seen what excessive leveraging can do at the global level, but we're not doing much to discourage it at the low-income country level. And also that, you know, if you are an IFC or a CDC co-financing a project in a developing country, you should get more information on the proposed financing composition. And the IMF, for example, should be much more accurate in forecasting future trends rather than just assuming that everything is equity and it will just kind of carry on rising. Another finding of the study is that there's been a big diversification of source countries and essentially towards non-OECD countries. While OECD FDI continues to be important, there's been very rapid growth in non-OECD FDI. And I show a graph here of Tanzania, and you can see from that, the bottom sort of light purple block, the importance of South Africa, for example. This varies for different countries, but you can also see listed down the right-hand side the British Virgin Islands and Mauritius. And you might legitimately say, why on earth would somebody in the British Virgin Islands want to invest in Tanzania? Well, that's the second part of that page, which is about tax havens. Essentially what you've got is a lot of people doing what's called round tripping. You've got a lot of Tanzanians putting their money overseas and then bringing it back again. So they put it in a tax haven to avoid tax, and they bring it back again when it looks like the economy is doing well. Now, this has clearly a very strong linkage into the whole global tax justice debate and the whole global tax discussion, and complicates very much what you're supposed to do with targeting your investment promotion. It really does underline the need for much closer reporting on all of this and much closer pursuance of tax evasion claims. In terms of sectors and regions, some countries are still vulnerable to concentration on a few sectors, but sometimes to listen to international publications, you would think that all FDI to Africa goes into mining and petroleum, and that just isn't true, and even less so true in other regions of the world. Many countries are seeing a lot of diversification into manufacturing, finance, tourism, real estate, construction, telecoms, and so on. And all of those sectors bringing extremely high returns. It's not true that you can only get high returns in the resource sectors. Again, just one example, there are lots more in the book. The Gambia. If you look principally in the Gambia, what are you seeing? You're seeing construction, you're seeing real estate, you're seeing finance, you're seeing hotels. You could say there are no resources in the Gambia, no natural resources. But that's an example of a country where FDI has boomed due to a completely different set of sectors. So this implies really there's more scope for investment in these different sectors, but there's also a need for countries to diversify their investment promotion efforts. And there's scope for international organizations and others who co-finance or guarantee funds to really be looking at those different sectors more than they do currently. We also have a chapter in the book about dynamic sectors and how they boom and bust even faster. But also the need really for everybody to keep a much closer eye on those types of dynamic sectors. If I take the example of mobile telecoms, which has been an absolute boom sector for the last few years, but the feedback we're getting now from most of the people on the ground is that that's becoming a pretty saturated sector in most countries, and it's not going to be anything like the recent boom. And so there's really a need to think about how you do investment promotion better. However, the negative message is that in terms of countries who are trying to have nationwide poverty reduction strategies and balance a bit better the regions that are poorest and promote development in them the most, unfortunately investment tends still to concentrate in some countries as high as 95% in or around business centres where infrastructure is better or where the natural resources are located. And therefore there's really a need to think carefully about this, because what you're having as a result of the boom in inflows is in a sense an exacerbation of the in-country inequality of different regions. And there really is a need to think about whether one can target incentives to accelerate development in poorer regions, as we do in Britain, or whether one can identify more other regional comparative advantages, but also particularly to provide missing infrastructure. One of the reasons why some of these regions are so underinvested within countries is that there's no way of getting there by road or rail, etc. So that's my initial part of the presentation. I'll hand over to Nils. I'll come back at the end. Or I'll come back over here, I'll stay over there.
Do you want to sit?
No, it's fine.
Okay, thanks, Matthew, Dirk Willem. The publication also covers actual investor views on factors determining the initial and current investment decisions, the medium-term outlook of enterprises in the various countries, and also questions on the practical contributions that enterprises might be making to development as well. So what are the key factors that have been encouraging or discouraging investment in the various countries? The most important, or among the most important factors, are market size, either national or regional, and also political and economic stability. These factors are seen as more important than factors relating, for example, to stabilization policies in the sense of low inflation, or competitiveness policies in the sense of low real exchange rates, which would benefit exporters rather than importers anyway. Labour productivity and availability are more important than liberal labour laws or regulations. And we also found, very interestingly, that investment and especially tax incentives were only of marginal importance overall. Many countries in the past have been applying blanket tax holidays for investors across a wide range of sectors. These holidays have not necessarily been very well targeted. And the lesson as a result of this is to ensure that governments are ensuring a level playing field with their domestic investors as well, and that they're targeting the sectors where investment is genuinely needed in order to promote development, and not those sectors which would anyway otherwise be highly profitable. One of the issues often covered in other exercises relates to state corruption. And we also found in this exercise that corporate corruption is as important an issue. And this needs a lot more research, and perhaps it implies tightening up OECD conventions and individual country laws. For example, extending the Extractive Industries Transparency Initiative or the Global Reporting Initiative to other sectors and industries, and also enhancing enforcement of those initiatives, which at the moment are voluntary. Views on infrastructure are mixed. Some parts of infrastructure are doing very well in terms of, say, telecoms. As Matthew mentioned, there's a lot of investment going into the telecom sectors. But other parts of infrastructure are lagging behind. And one of the main constraints investors come back to time and again relates to the availability and cost of electricity supply, for example. Health issues are also important, as these impact on staff turnover, absenteeism, and also on the maintenance overall of a stable and trained labour force. Investors believe that education is critical to boosting the quality of their human capital, and a particular focus is needed on malaria, health systems, and secondary or vocational education. And as I'll come back to a bit later, there's a role for the private sector to fill gaps in public spending in this area. Environmental issues. A few years ago, these were particularly unimportant in investor surveys, but over recent years, they've been becoming increasingly important. For example, in the case of Gambia, which has experienced significant coastal erosion, this has had a major effect on its tourism sector, which accounts for a large part of its foreign exchange earnings. And of course, droughts and floods are impacting on subsistence and cash crops. To show an example from Burkina Faso among many, we can see here that the main constraints are health-related and tend to be health and environment-related rather than economic and political concerns. Perceptions vary among different investor groups and need to be tracked and analysed in a disaggregated way. At the moment, countries are collecting the data to do this, but there is scope to do further analysis. And the different groups we have in mind include the differing perceptions among exporters and importers of various factors. Different investors have different motivations. Some of them are seeking markets, some are seeking natural resources, and some are seeking efficiency gains. Domestic and foreign investors also have different views on various factors. For example, access to credit tends to be a major concern for domestic investors because the financial sector is highly limited in the amount of long-term credit, if any, that it can supply to businesses. Whereas this isn't so much a concern for foreign investors because they have greater recourse to borrowing from abroad or borrowing from a parent company. Potential and actual investors also have very different degrees of perception. And Matthew mentioned the earlier book that we published, and this came out very strongly there with a supply-side study. And we found that investors on the ground tend to be a lot more bullish and work around constraints than potential investors who are thinking about whether they should be coming in or not. Of course, there are differences as well in the perceptions of large and small enterprises. Large enterprises might have scope to work around certain problems that small enterprises don't, etc. And perceptions can also change dramatically in the wake of a crisis, which highlights the need to conduct regular surveys to track this and maintain dialogue to address various concerns. Which takes me on to how to respond to investor perceptions. Clearly, these can provide valuable insights and reflections as to how well countries are doing in promoting an investment climate. However, the views that they express should not necessarily lead to any knee-jerk policy responses, as countries have been inclined to do in the past. For example, investors can be wrong or can be ill-informed on particular issues. They will always complain about tax, even when this is lower than in other countries, or has been recently reduced, or about interest rates while interest rate spreads are narrowing. This may imply a lag in the rate at which perceptions change, and government can address this by announcing positive changes quickly and clearly, in addition to which investors want to see that changes are sustained, so they might wait a while before they express positive views on something. It should also be pointed out, with reference to a lot of the other studies we've been looking at, international studies have tended to focus on larger investors and foreign investors. But this particular group is only one of many stakeholders, and their perception should not necessarily predominate over others, including small and medium enterprises, resident investors, trade unions, civil society, etc. Perceptions thus need to be weighed up and compared with objective analysis and the impacts on the other groups assessed. And government and business likewise need to maintain dialogue about whether perceptions are justified and what are the appropriate policy responses. Governments need to have the same dialogue with these other stakeholder groups, such as those that I mentioned, and make policy recommendations to improve their circumstances as well in the context of wider national development strategies in order to avoid conflicting actions. To close my part, looking at the development prospects and impact, there's urgent need to know more about what investors intend to do, and this involves being forward-looking in the context of predicting the likelihood of future private capital related shocks, for example, and also what investors are contributing or potentially contributing to development. So for these reasons, the study and the country exercises have been covering investor intentions. For example, will they expand, maintain, or contract their investment into in the medium term? And if they plan to maintain or expand their investment, in what areas is that going to go into? And it also covers issues on the practical steps that they're taking to contribute to national development. And this goes beyond, for example, an awareness or signing up to global CSR-type declarations and broad policy statements to see to what extent they're actually undertaking spending, for example, on human resources in the sense of training, health, education, promoting gender balance in their workforce, environmental protection and infrastructure. And I'll come back to one or two examples on that in a later slide. But to give some summary results, in normal times at least 50% of investors, and this can be up to 70% in some countries, are planning to increase their investment. And generally less than 10% have been planning to reduce their investment. The following graph, the blue part of that shows the percentage in each country planning to increase, and the red part shows the percentage planning to maintain, and the white part those planning to contract. So that the picture is generally positive, and it's interesting to note that for those countries that conducted surveys with a reference period overlapping with the global crisis, that perceptions still remained reasonably positive, for example in Gambia, Uganda, Zambia and Senegal. Which implies that they were taking a medium to long-term view beyond the current situation. On the plus side, we found that most businesses are aware of the issues, and many have policy statements on particular areas. And these might either be formal or informal. Enterprises also have an awareness of the extent to which they're meeting their targets. And in this respect, there is a wide variation, we found, in the levels of attainment within and across countries. Generally, targets are being met for recruiting nationals in preference to expatriate staff at a greater rate than targets are being met for promoting gender balance in the workforce. However, in both areas, performance is performing well short of the targets enterprises are setting for themselves. But only a small number of enterprises are indicating that they've been making zero progress in these areas. There's also a willingness on the part of enterprises to do much more, and wide acknowledgement that this is not a philanthropically motivated, but increases their business returns. Action can be increased by encouraging enterprises to emulate best practices, showing how this can be done profitably with best practices from other enterprises, and by urging enterprises to spread these best practices through their supply chains. But while companies may be willing to indicate the existence of targets, verifying their assessment of progress remains a key challenge, and this is an area of methodology that we're working on developing further. As I mentioned, companies are acting in their own interest to supplement shortfalls in public spending, and again the reasons for this are not philanthropic, but purely because it benefits their enterprise. And some examples we've come across relate to infrastructure. For example, certain companies in the mining sector have been building local road networks, providing electricity generators for the local regions. With respect to health, some enterprises have been providing health care for their staff and families, and the motivation for this is to maintain a stable workforce. And also with respect to education, several enterprises have been undertaking their own training programs, and the purpose behind this is to improve the quality of their human resources. I'll hand over to Matthew to close with the...
I can do it from here if we can move the mic,
Okay.
or I can talk to
You
this
can
mic.
you can talk
If
at
you
that mic, isn't it?
If you
Yeah.
just move the slide down, then people can see it on the screen. Yeah. I wanted to really finalise with two sets of policy recommendations, one at the level of the countries and one at the global level. But let me also say that last slide of Nils's is in no sense an endorsement of the idea that public infrastructure should be provided by private companies. I was in Washington last week partly to deliver an Oxfam study, which we just written for Oxfam, about the impact of the crisis on countries' budgets. And low-income countries have got about a $64 billion budget revenue hole as a result of the crisis, which is not being adequately filled by international financing, but it's also forcing them to cut back on some of these different types of expenditures. So the impact of the crisis on budgets means that, in a sense, there might be more pressure for private companies to fill these types of infrastructure holes. But the example of Anglo-American that I gave at the beginning in Zambia just shows what a risky aspect that is and how you can't rely on private charity to fill the types of infrastructure gaps that public funding can. So, at low-income countries' national level, what does this mean? It means we need some major changes in thinking by finance and planning ministries and central banks about what to do about private capital flows. An early warning system of monitoring to foresee any future problems, enhanced analysis of foreign private capital to include forecasting sustainability and risk, monitoring composition much more closely, analysing private sector external debt. It also means major changes in the ways investment promotion agencies and policies operate, with more monitoring and analysis underlying them. There's been some trend recently to make investment promotion agencies into sort of facilitation people, but they can't facilitate if they don't know what's actually happening to the flows. Information dissemination on the higher profit levels that companies are achieving, more nuanced promotion policies for new sectors, sources, and so on, monitoring perceptions and behaviour regularly to design policies. And we think it's very important that the investment promotion agencies should have their performance assessed not just on the amount of money that they get in approvals, but actually on the type of impact that the funding is going to have on development in terms of job creation, technology transfer, and so on. And the international community could help in two ways here. One is to spend a considerable more amount of money on actually building low-income country capacity to do analysis and policy, and not just to facilitate investment, including reviewing the structures and policy focuses of central banks and IPAs. They've already been doing that for themselves, the countries, but they find it's quite difficult to restructure the way they're doing things if the international community is pushing in another direction. And secondly, reviewing their policy interactions with low-income countries and their own country analysis and forecasts to ensure that they're actually looking at all the relevant factors for foreign private capital promotion and stability. For example, a lot of the international literature focuses on liberalising regulations and on the process and the type of doing business stuff, which is great, it's part of the issue, but what we find from the surveys is that health is the number one factor. So if you really want to promote foreign investment, then spend more on public health so that they have reliable labour forces. And they should also be looking at foreign private capital's contribution to development. Quite often it's forgotten that this should be a two-way street, that it shouldn't just be about what government can do to facilitate investment, it should be about what investors can do for national development. At the global level, more detailed analysis of what's actually happening and the huge impact that that can have on low-income countries' economies and their prospects for reaching the MDGs. We need detailed analysis of composition, volatility, the drivers, the development impact, and so on. More information exchange on global trends and drivers by the BIS, the IMF, and the World Bank. We were, in the regulation meetings I had in Washington last week, we were talking about, is it not possible for developing country banking authorities to at least get some warning of what's happening with global banks before they collapse completely? For 10 years, ever since BCCI collapsed in this country, developing countries' banking systems have collapsed as a result of those global banking collapses, and they didn't even know it was going to hit them. So you wake up the next morning and you can't issue a traveller's check or anything. More dissemination of the positive information on FPC, high profits, sector and source country diversification, and analysis also of what these trends mean for how development finance institutions like IFC and CDC should change their strategies. They're also a little bit stuck in old resource-based, OECD-centred strategies quite often. We also think it's very important to assess the performance of those organisations based on the additionality of the funds that they mobilise, not just the amount, and the contribution to the development of those funds. And we think it's important that policy recommendations at the global level and analysis should be changed even more to reflect what really matters for promoting FDI, and above all, not to focus on tax incentives. I noted with pleasure recently in Mozambique that the IMF is now actively producing pressure on the government and joining the government in saying that there should be an abolition of global tax incentives for foreign direct investment. And finally, that this does need to be raised as a major issue in the G20. There seems to sometimes be a split between the idea that, low-income countries, that's a development issue, and global financial architecture, that's a emerging market issue. Well, it's not true. What we've both been saying today is that we're all integrated. There is a strong need for these issues to be on the development part of the agenda. I was very glad to hear from the Korean Sherpas last week in Washington that they are planning a key set of development discussions, a development day, essentially, in the Korean G20 summit in Seoul. And it seems to me these issues really should be on the agenda for that. Thank you.
Very good. Well, thank you very much. It's been a very rich discussion. And there were lots of points that are